Hey guys, my name is Nicolette Mashile. I am also known as The Financial Bunny. Welcome to The Financial Bunny TV. Now, if you are somebody like me, you're keeping your eyes glued, you are reading, but you're also keeping your ear to the ground, and you may have heard the breaking news in the last 2 weeks. Bitcoin has now hit over $100,000 for one Bitcoin. Now, think about it. In South African rands, that is over $1 million South African rands for just one Bitcoin. And all of us are scrambling to try and invest in cryptocurrencies and of course into Bitcoin. So I want to tell you a little bit about Unity Wallet, which is a self-custodial cryptocurrency wallet that allows you to manage, to store your cryptocurrencies or your digital assets securely and intuitively. This means that you have all control of what it is that you are doing using the Unity Wallet, right? You can sell, you can buy more cryptocurrencies, you can swap across many different types of cryptocurrencies, but also most importantly, you are able to use cryptocurrency as a payment method across 4,000 products and services. You also are going to be gaining and actually getting some rewards when you transact using a Unity Wallet. How absolutely fantastic is that? Where they are taking out the crypticness, the complexities of managing, storing, buying, selling cryptocurrencies. So don't even think twice. These are the guys that you want to use if you are looking to manage, to store, to buy, to sell, to swap your cryptocurrencies. It is, of course, Unity Wallet. Go to my link. You will be able to find a way to maneuver to get the platform so that you are able to use it. I don't even know what to title today's video, but I'm just going to get into it because I had a very interesting conversation last week. So I went to a Christmas year-end party of one of my clients. By the way, for those of you who have small businesses that are looking to spread your wings, get a little bit of more media exposure, do some digital content, marketing, brand positioning, reputational management. Maybe you're a founder and you're looking to have more or start speaking gigs, emceeing. I'm your person. I will help you. I will help you position your brand so that you are somebody that becomes a thought leader in the niche that you have selected. But I do work with people that are thought leaders. So for instance, I will work with a mining house, or I will work with somebody who is maybe creating detergents, or, so you've got to be niched in a specific industry for me to be able to help you. So even if you want to be a speaker, what specific industry do you want to speak in? Then it's easier for us to be able to position you. So if you're looking for those services, I'm definitely your girl. But in any case, as I was sitting at this year end, I was talking to this young man. So he's one of the co-founders. By the way, he's very young, and it's very important for me to mention this because what I have found in the last couple of years is that young people, please do not undermine them. They are doing absolutely amazing things in this country, and you are never too old to learn from a young person because you know what? They may know something that you don't know. They know it better than you, or they found a hack. Especially when it comes to personal finance management and growing your wealth. These guys are doing some crazy things, and you know what? It's worth giving them an ear. So basically, this young man was telling me about his property portfolio and how big it actually is and how he's been very successful in building a property portfolio, right? So I was asking him, well, okay, how quickly did you do it? How did you do it? What was your strategy? And he was like, my strategy is very simple. I bonded one house when I was still working, and right after bonding that one house, I paid it off as quickly as possible. And now we know the easiest way to pay off a property, if you want to pay it off within 5 years, 10 years, is basically pay extra into your loan account. It's very simple. I was actually doing the calculation. If I pay just an additional, I think 2,000 Rand into my loan account for my property, I can pay it off in 5 years. That is actually wild, guys. But that's literally what it looks like, right? If you pay double, you may even finish it off in less than however many years. And I'm saying the 2,000 because one of my property bonds is very, very low. But it's really the extra amount that you pay is how you actually finish off a house quickly. So basically what he did is he finished off this house quickly. So then he was sitting with a paid up house, right? As he's sitting with the paid up house, he's like, okay, how do I then get my next couple of properties? He then went to the bank and rebonded that house. So the bank then gave him an amount. After evaluating the property, they gave him an amount based on the equity of the house. So they rebonded the entire property, right? So now he's got a new bond on this property that he already has, right? So goes to the banks, does the whole credit application. Remember, you've got to do the credit application once again because it is a credit agreement or a credit application that you are making. So they'll do the entire credit application once again. And that's very important because people think that the bank will just give them money based on the fact that they've got a property. No. So the bank will come and do a valuation of the property. Then you will do the credit agreement and they'll tell you how much they're willing to give you. Then you will say, okay, I'm willing to apply for a rebonding on this house of the full amount or less than that. So most banks will give you, I think, between 60 to 80%, or up to 60 or up to 80%, depending on the bank that you're going to. So let's say the bank values the property at R1,000,000. The bank then says to you, okay, we're willing to give you 80%. So they'll give you 800,000. Then what he does is he takes the 800,000 and goes to look for 2 other properties. The 2 other properties that he's now looking for are either 800, let's say each one is 800,000, right? So what he's doing is he's buying 2 properties that are both 800,000. However, he's going to put a deposit of 400,000 on each one of those properties. Do you understand what he's doing? So 2 properties now. So now all of a sudden his portfolio is worth 3 properties, right? But with the 1 property, he's able to use that money to be able to buy 2 other properties where he's going to put a deposit of 400 on one and a deposit of 400 on the other, which means that he now owes 400 on this one, 400 on this one, which is the 800 essentially, right? That he, well, not essentially the 800 that he borrowed because that, or he got out of his property because now he has that amount of money. So he's got an installment now on the old property that he's bonded, and then he's got 2 other installments on the new 2 properties that he's been able to acquire. Right? This is very important. Again, those 2 are going to be credit agreements. So it's important also to remember that they're going to be credit agreements. So you're going to get assessed again. So essentially, you still need to qualify for the 2 new bonds that you are going to be getting on these 2 new properties that you are getting. Right? Very, very important that you understand that part. So as I was thinking about it, and I was like, okay, it sounds like a good idea. It sounds practical. Obviously, it's not as easy as I'm making it sound, and I guess as he was making it sound. However, I thought about it, and this morning, as I was having a conversation with my partner, yes, guys, as I was having a conversation with my partner was like, why don't you just bond the property, get that money, but then diversify your investments? So instead of going back to property, because I was telling him that earlier on this year when I broke my ankle, one of the things that I realized was that I was heavily invested in property. 90% of my investments or my money was literally sitting in brick and mortar. And that becomes very problematic. And it showed at the beginning of this year, because at the beginning of this year, I needed cash. I needed to run my life. I needed to buy groceries. I needed to pay my helper. I needed to pay my retainers of my videographer, all of those people. And I'm sitting now with a big problem, because the big problem I'm currently sitting with is that I am not working because I've got a broken ankle. However, I have property, I have investments, but my investments are property. And it takes 6 to 8 months to sell a property in this country. And that is in favorable economic environment. And you know, we were not in any economically favorable environment at the beginning of this year. Interest rates were very high. Inflation was rearing its ugly head. Things are just not looking good. We were in a buyer's market, basically. So we were sitting with that problem. So I could not sell. And now I can't walk into Pick n Pay or Woolworths and say, guys, can you give me 5,000 rands of grocery? Don't worry, I have a property portfolio worth 18 million. And, you know, when I sell a property, you guys will get your money back. Woolworths will be like to me, CC, we want hard cold cash here. We don't have time for you telling us about how great your investments are. So then my partner was, based on that, he was like, why don't you then take out the money? So bond the house, because if you bond it and you negotiate a good interest rate, you're probably going to get some of the most cheapest debt through a bond, right? Probably going to be the cheapest debt because it's probably going to be a lower interest rate, but also they give you the 20 years to pay it off, which means that you may be paying like 8,000 rand if you're taking out like R1,000,000 rand if you negotiate your interest rate. And that means that you need to have a good credit score. So that doesn't just happen. That's why I've got one of my videos on this channel that speaks about investing in your credit score, because you don't know when you're going to need it. We don't fix credit scores to get debt. We fix our credit scores so that they become a great investment for when we are going to need to use a credit line. Then we get favorable interest rates. So that's also something that I want you to keep at the back of your mind. So he then says to me, Imagine if you go to the bank, you bond one of those properties, let's say it's R1,000,000, the bank gives you 800,000 Rand. Worst case scenario, you're probably paying 6,000 to 7,000 Rand every single month. But if you take the 800,000 and you go and look for 4 different cars, 200,000 Rand a car. I'm just making a very simplistic math example, right? You buy 4 cars, you put them into Uber, and you are making 20K a car. Let's say your 20K is the gross, you're netting 15,000, 14, 10,000. And even if you're netting 10,000 Rand on each car, the return is better than what it would have been on a property. We know that the yield on a property is a little bit less than that. However, there is a difference, right? A car is a depreciating asset, whereas a property is an appreciating asset. So with me, it would work because I already have my asset allocation already has property in it. So I already have a big chunk of my money invested in property. There's no need for me to go to property again. I can actually create that liquidity within that property and take that money and put it into something else. One of my biggest dreams is to build this thing, and I can't tell you now because I'm really going to press go on it, is to build this amazing thing. But think about it. I mean, let me use an example that can be easy and everybody can relate to it. Writing my next book, right? I'm busy writing my next book. I'm self-published. Now, the thing about self-publishing is that it costs you a lot of money at the beginning because you've got to write the book, you've got to get it edited, and editors cost money. You've got to get a designer to design the cover of the book. That costs money. You need to print copies of that book, especially when you're going live with your publishing, because what you don't want to find yourself in a situation is where people are looking for books, but you don't have them published. And then you've also got to get them distributed. Now, if you're using a distribution channel like your exclusive books, your bargain books, some of the early on initial orders are huge orders, right? You are getting orders left, right, and center, and you need to be able to send those books to all of those different bargain books and the different exclusive books, which means that you need to also have a distribution cost. And then last but not least, you need a marketing cost because nobody's going to buy your book if they don't know it exists. So you need to put a marketing budget behind it. So let's say worst case scenario, it costs you around about 300,000 Rand for you to publish a book that is going to be successful. And if you're self-publishing, remember also all of the money comes back to you. So now you need to make an initial investment of 300,000. So then I go and I bond a property. I get the 800,000 Rand out. I get the 300,000 that I need. I don't even have to bond it at 800,000. I could even say to the bank, look, even if you valued it at 1,000,000, I only want to bond it for like 400,000 Rand. The bank bonds it at 400,000 Rand, gives me the 400,000 Rand. I take the 400,000 Rand, and then I show them also that it's actually a property that has a lease already on it. So don't worry about the repayment. The repayment is not necessarily also dependent on me because there is a lease that is attached to this property. So then I get the 400,000 Rand out. I go pay for this a book to get published. I've got a marketing budget. I've got everything. I'm literally backing up this book with the finances that it needs for it to be successful, because we know sometimes it takes money to make something successful, right? The book sells itself. I mean, at let's say, worst case scenario, you're selling the book at, let's do a quick calculation. If the book is selling at 250, if you take 400,000 and you divide by 250, you need to sell 1,600 books. 1,600 books is not bad. What you do is then you go and target your corporate companies, you target your financial companies. So you literally need to sell 1,600 books to be able to pay back the 400,000. Do you understand? Once you go over the 1.6, you're now making clean profit from this investment that you have created. So that's what I was thinking about, and I was when my partner was telling me, actually put your money into something else, diversify. You could put it into live cattle. You could put it into maybe a shop. If you've done your mathematics, you've done the numbers, and you know what, you think that you've tested the market and the market is looking for a product that your shop is going to be selling, that's another way to look at it. So there's various ways in which you can fund your own initiatives, but of course it does require that you have that fully paid up property. So it's not for everybody. I'm just saying that's something that I would do because I already have the fully paid off properties. So if you are even encouraged, or you're looking for encouragement as to why you need to pay extra into a property that you've already bonded, especially an investment property, this is an encouragement, because you don't know when you're going to need to take out money out of a property. So this is a great encouragement. So it's simple. The steps are simple. What you need is you need a fully paid off property that has a tenant that is already there. There needs to be a lease that is signed, that is on the table. You go to the bank, you say, guys, I want to rebond this property. The bank will do a credit analysis of you, but also you've got the lease as your collateral to say, look, it's not just from me and my affordability. There's already another tenant that's in place that is going to pay for this thing, right? Then the bank maybe doesn't give you the full valuation as a bond. They give you half of it. You take that half of whatever it is that you need and you go and put it into a different business venture or a different investment. Now what you are doing is you are diversifying your investments. So you're not putting your money back into property. You are taking the property and you're using it to be able to invest in other asset classes. Does it come with the risk? Absolutely. Absolutely. The business that you're going to go into or the new investment that you're going to put your money into might just fall flat on its face. That's the reality of life, right? That's the reality of investing. But it is worth taking the chance, and I'm willing to take the chance. I don't know about you. Let me know, if you had a fully paid up property, where would you put that money into? Now, to close off this video, I do need to remind everybody, none of my videos constitute as financial advice. So please, if you are looking for financial advice, speak to somebody who is certified and registered with the FSCA to give you financial advice. I'm going to leave it at that.